Welcome everyone. We'll just give people a few more minutes to join. Hi everyone, a warm welcome to today's King's Expert Series webinar on the economic impact of COVID-19. This webinar is part of our online event series for our global alumni community, where each month you can tune in and hear from some of our leading academics, researchers, and practitioners on some of the most pressing issues of our time. If you've missed any of our webinars, you can find them on our King's Alumni YouTube channel. And just so you know, today's event is also being streamed live on YouTube. Today, our expert panel will share their perspectives on the valuable lessons we can take from historical recessions, how long it can take to exit from a recession, and what policies might help with this process. I'm delighted to introduce our panel for today's discussion. We've shared the bios in advance, but I'll just give you a quick introduction. Our chair for today is Professor David Aikman, Director of the Qatar Center for Global Banking and Finance and Professor of Finance. David is joined by Dr. Francesca Monti, Deputy Director of the Qatar Center for Global Banking and Finance and Senior Lecturer at King's Business School. Professor Jonathan Portis, Professor of Economics and Public Policy at King's College London. And last but not least, Dr. Gash, Lecturer in Economics at the Department of Political Economy at King's. Just a quick note on the format of the event before handing over to our chair. Following introductory remarks from our panel, we'll then turn to questions from the audience. Thank you to those who've already submitted questions in advance. We have them on hand. If you do have a question during the webinar, please use the Q&A function at the bottom of your screen. As we've got a lot of you on the call today, we might not be able to answer to all of your questions, but we'll do our best to get through as many as we can. You can also participate by pressing the like button next to other people's questions, so we can see which questions are the most popular. As usual, you can also continue the discussion on LinkedIn using the hashtag King's Experts Series. I will now hand over to Professor David Aikman.
Thank you very much, Francine. Thanks for the very kind invitation to chair this panel, and a very big welcome everyone to this evening's webinar, where we'll be discussing what is an extremely important question, namely the economic impact that COVID-19 is having and prospects for the economic recovery that hopefully lies ahead of us. So as Francine said, my name is David Aikman. I'm the director of the Qatar Centre for Global Banking and Finance at King's College London. This is a new research centre that's dedicated to studying the role of central banks in the global financial system and the challenges they face. Before joining King's, I spent the best part of 2 decades working as an economist at the Bank of England. Now, it's worth reminding ourselves at the outset just how large the economic hits from COVID has been. 2020 as a whole looks set to be the worst peacetime global recession since the 1930s and the Great Depression. The International Monetary Fund estimates that global GDP last year fell by 3.5%. Now, that experience has been uneven across countries, and some have suffered worse than others. In the UK, for instance, we've seen the largest economic contraction for over 300 years since the Great Frost of 1709. Now, the good news is that economists are expecting a robust recovery from this point. The IMF is expecting global growth of 5.5% this year and a little over 4% next. And actually, just today, it's announced that it's even more optimistic about the outlook than it was. And one reason for this kind of upward revision of forecasts is the successes we've had with vaccine development and rollouts since the autumn. Another is the effects of the enormous policy support measures that have been put in place in a number of countries. Now, of course, all economic forecasts are hugely uncertain, and this one is surrounded by, I guess, what we could only call exceptional uncertainty. And I think there are a few key risks to the recovery that are worth, drawing specific attention to. The first one that I'd highlight relates to the evolution of the pandemic itself, which I think will obviously have a first order impact on the shape of the recovery. In essence here, the question is really who wins the race between mutations of the virus and rollout of vaccination programs globally. The second risk I'd highlight is that the macroeconomic support measures I mentioned that have been taken in recent months basically achieve too much and the economy overshoots, causing inflation to rise. Now, the Biden stimulus package in the United States, for instance, is the largest fiscal package we've seen since Roosevelt's New Deal. And a lot really depends on how households respond, whether these checks they're receiving in the post will be spent or saved, and also what happens to the buildup in savings we've seen across the economy for those of us who've been lucky enough to stay in jobs throughout this period. Will they be spent or will those savings continue? Now, you might argue that the Fed could always increase interest rates if the economy did begin to overheat. But we should remember that there's always a risk of kind of doing too much, and that would lead to a recession if interest rates went up too strongly. Equally, the Fed might be a little bit reluctant to act if doing so increases the burden of servicing government deficits. So I think there are risks on both sides there. The third risk I'd highlight relates to financial stability. The large increase in fiscal spending we've seen to fight the crisis has raised public debt levels to record highs in many countries. Low interest rates means that servicing that debt is very manageable right now for most countries, but we can't assume that that will continue indefinitely. Relatedly, some economists are worried about the level of asset prices, which are extremely high, reflecting the positive outlook that we now have for the economy. But if interest rates were to rise, perhaps reflecting inflationary concerns, we could see a material fall in stock markets around the world. And lastly, many economies entered the crisis on the crest of a large boom in corporate debt. And I think when pandemic support measures are withdrawn, we are likely to see a wave of bankruptcies, which could in turn flow back to banking systems. So that's the outlook, a brief description of the outlook and some of the risks to it. I'm delighted to say we have a really distinguished set of panelists to discuss these questions and more. Our first speaker is going to be Dr. Francesca Monti. So Dr. Monti is Deputy Director of the Qatar Centre for Global Banking and Finance at King's. Before joining King's, she was my colleague at the Bank of England, where she led the bank's work on macro forecasting and on monetary policy strategy issues. So Francesca, without further ado, over to you.
Thank you very much, David. And also thank you, Francine, for the invitation to this event, which is very interesting. And I really look forward to hear more also about my what the other fellow panelists will talk about. So without any further ado, let me jump into what I wanted to talk about. The first thing I would like to do is look at the past experiences of pandemics to understand if we can learn something from the past in terms of the economic effects of pandemics. So of course, no pandemic is the same as the previous one, but we do think that historical data can help assess the effects of the COVID-19 pandemic, and indeed also of the subsequent public health response. So what I'll do today is to draw from recent research on the topic to give some insights on the issue. Let me start by considering what we can learn about the effects of the pandemic on the economy. One of the first papers I want to tell you about is by the researchers Jorda, Singh, and Taylor, who use newly available data on yields of long-term return on long-term sovereign debt stretching back to the 14th century to estimate the response of a European natural rate of interest following 15 major pandemics since the Black Death, so almost a millennium. They find that the great historical pandemics throughout this period have been associated with subsequent low returns in assets. Indeed, pandemics have been followed in general by sustained period with depressed investment opportunities, presumably due to excess capital per unit of surviving labor and a heightened desire to save, either for precautionary saving motives or to rebuild the depleted wealth. Now, looking at the historical trends from thousands of years ago can be, or several hundreds of years ago can be interesting, but there is a caveat, which is the fact that most of the past pandemics occurred at a time when virtually no members of society survived old age. And so it might, while interesting, it might also be useful to look at more recent events. So let us now zoom into the 1918 influenza pandemic, which has features that are more similar to the current pandemic. For that, Barrow, Ursu, and Wang look at data on this period, on the 1918 flu, for 43 countries, and find that higher flu deaths generated declines in GDP and consumption of on average 6% and 8% respectively. There's also evidence that higher death rates because of the flu decreased realized real returns on short-term government debt. Turning to wages, there's an interesting study by Basco, Dominic, and Roses, which studies the effect of pandemics on wages using data from this Spanish 1918 flu, indeed within Spain, exploiting the within-country variation in the increase in the number of deaths, trying to understand what the effects have been on real wages. And they find that indeed, the effects on real wages have been negative and large, but overall short-lived, and that these effects were exacerbated in more urbanized regions, and as we might expect, were stronger in occupations producing non-essential goods, for example, like shoemakers at the time. So historical data can indeed give us a sense of the economic effect of pandemics, but can it also give us some insight on the effect of the public policy response. So the debate on public health interventions, such as lockdowns and social distancing measures, etc., is often framed as a trade-off between saving lives or saving the economy, but it's not that simple. A very interesting paper on this is that of Correa, Luck, and Werner, who use regional data from the 1918 flu pandemic in the US to study the effects of non-pharmaceutical interventions, so interventions like social distancing measures and wearing masks, etc., on the economy. So there, they also exploit regional differences in the severity of the pandemic and the varying intensity of public health interventions to assess the relative effects of the more stringent measures. So first, in line with the evidence I discussed earlier, they find that areas that were more severely affected by the pandemic saw a sharp and persistent decline in real economic activity, driven both by supply side and demand side channels. Interestingly, however, they also find that social distancing measures did not seem to worsen the downturn. To the contrary, evidence on manufacturing activity and bank assets suggests that the economy performed better after the pandemic in areas that had more aggressive public health policies. And the reason for this is that even if the restrictions did depress the economic activity when they were in place, these measures mitigated the most severe and persistent economic disruptions of the pandemic and therefore reduced its severity on the economics. So cities that intervened earlier and more aggressively with social distancing measures experienced a relative increase in real economic activity after the pandemic subsided. And so for my intervention now, I'm going to leave it to this, saying that I think there's a very interesting work being done looking at historical data on, on the economic effects of the pandemics. Thank you.
Thank you very much indeed, Francesca. That was very thorough and I think very useful framing for the issues we're going to discuss today or this evening. So our next speaker is Professor Jonathan Portes. Jonathan is Professor of Economics and Public Policy at King's. Prior to joining King's, he was Chief Economist at the Department of Work and Pensions and at the Cabinet Office in the UK. He was also Director of the National Institute for Economic and Social Research. So Jonathan, the floor is yours for your opening remarks.
Thanks very much, David. Thanks for Alter inviting me. Since we have two such distinguished macroeconomists and former Bank of England officials, I'll dodge the question about what's going to happen to inflation and talk about some of the structural issues. I mean, first, just looking back and to build a bit on what Francesca said, I think one of the interesting things about where we are now and what's happened over the past year is the degree of consensus sort of across the ideological spectrum of economists about a number of key facts about the pandemic and its crisis response. First, as Francesca said, with evidence, a really strong pushback by economists against this idea that there was a direct, simple trade-off between health and economics. There really was this consensus that actually, in order to solve the economic crisis, you had to solve the health crisis first, and that was the right way of thinking about it. Second, and sort of following directly from that, economists were, and again, this is sort of counterintuitive and perhaps counter what many people have expected, were very relaxed about the very large falls in GDP we saw in the spring and summer, as opposed to saying, oh God, this is a disaster. The response from economists was very much, well, of course, if you're closing down large sections of the economy, you will hit GDP in the short term. What's really, really important is to put in place policies that ensure that short-term damage doesn't become long-term damage. There isn't long-term structural damage to the economy. And then third, and again, following on from that, again, perhaps in contrast to some preconceptions, a really remarkable sort of lack of worry amongst most economists, even among some who had been more concerned about fiscal policy and the expansion of government debt back in the early 2010s, to saying, look, in this crisis, we really shouldn't be worried about debt and deficits. Of course, the deficit is going to balloon out when the economy has shrunk by 15 or 20%, and when the government is rightly doing a lot to support the economy. That's natural and not really something to worry about. So I think in that respect, I think we can, economists have been remarkably unanimous and clear on what should happen now. Where does that leave us as we move into this recovery? As David mentioned, there are concerns on the macro front about inflation and interest rates. I'm in some ways sort of less concerned about those, not that they're not real, but that we sort of have the tools to understand and deal with them, and more about the distributional, structural, and microeconomic consequences and challenges that we face. There was a lot of talk early in the pandemic about whether we were facing whether we'd have a V-shaped recovery, a tick-shaped recovery, or a W-shaped recovery. I think the real worry now, and this is not a letter that I invented myself, is genuinely of a K-shaped recovery. That is, that for me, for most of my colleagues, and most, if not all, of the people on this call, actually, our incomes, our jobs have mostly held up relatively well during the pandemic. And indeed, since our spending is not, we are actually relatively cash rich at the moment, which will help drive a strong recovery. That is not the case for the other half of the population who either lost their jobs, seen their wages reduced, if not eliminated, or face job insecurity as we come out of the pandemic. And so this worry that what we'll see is perhaps something that looks reasonably okay at the overall macroeconomic level, but sort of conceals quite severe inequalities and disparate impacts at the micro level is what I'd be most worried about, both in the UK and in other major developed economies. And then, of course, there are these sort of longer term questions: is how does the pandemic and its aftermath interact with the challenges, the structural challenges that Western economies face? In particular, well, in the UK, of course, Brexit, but more broadly in all advanced economies, the changing nature of work and the capacity for technological change and changing in nature of work to further exacerbate structural inequalities. That, I think, is one of the big challenges. The other one being obviously carbon climate change, and what are the structural changes required to move towards net zero, something that this government here has actually been commendably ambitious about, but we don't yet have a strategy for. That's probably enough of an ambitious agenda for an introduction. So I'll stop there. So as I said, I think, to conclude, I think I'm sort of relatively relaxed about the macroeconomic position in the short run, but the structural issues we face have certainly not gone away, and in some respects have been exacerbated by the last year. And it will be both an economic and a political challenge to governments as to how they deal with that.
Jonathan, thank you. That was really stimulating and very, very clear and wide-ranging all at the same time. So thank you very much for that. Okay, our third speaker, I'm delighted to welcome, is Dr. Carly Gash Corral-Baeva. Carly Gash is lecturer in economics at King's College London. Previously, she was a teaching fellow at the London School of Economics and a research fellow at the University of Oxford. So, Carly Gash, I know you're going to touch on climate change issues, which Jonathan just mentioned. So over to you, the floor is yours.
Thank you so much, David, for introduction, and hello, everyone. It's a great pleasure to be part of today's event. Yeah, so I would like to discuss, I guess, in my introductory remarks about the role of green recovery. So I guess we're talking about not only about the recovery itself, but also we understand that the nature of the recovery is very important. And we see evidence that of effects of climate change getting more visible and evident around the world. we also know that the cost of mitigating climate change are substantial. On the other hand, if we require large public spending and support to deal with economic fallout of COVID-19, then the obvious question is, can we redirect those funds also to reduce our carbon footprint? So in other words, can we have this double dividend from those stimulus packages that many governments pledged so far? So I will give you some example. So last October, Cambridge Econometrics published a report in which they looked at two different recovery plans. So the first one, they labeled as sort of traditional recovery plan as from any recession, which mostly focused on analysis of the effects of reduction in VAT taxes. And the second recovery plan that they focused on was green recovery plan. So in addition to reduction in VAT taxes, but by the smaller amount than in the sort of traditional recovery plan, that plan included investment, green investment, such as improvement in energy efficiency, upgrading electricity grid, renewable subsidies, and so on. So they have looked at several countries in Europe, including the UK, US, and India. So overall conclusion which emerged from the analysis is that even both recovery plans lead to boosting economic activity and increase in employment, the green recovery plan has longer lasting effects on economic growth. And I guess this is not surprising because we know how climate change affects agricultural sector negatively. We also know that our summers are getting hotter, which affects labor productivity. So there are different channels through which addressing climate change can have sizable impacts in terms of economic benefits for the economies and the society. So David has already mentioned large fiscal stimulus provided by or pledged by Biden administration, 1.9 trillion, not billion, trillion US dollars, which has been approved by Congress. And I believe that the large part of that stimulus package will be directed to reducing carbon emissions from electrical sector. In the UK, we have achieved significant progress in reducing carbon emissions from electricity production, right? Mostly through phasing out coal. And last summer, so the government pledged 8.6 billion pound sterling support into green infrastructure and renovation. And also last November, the Prime Minister set out a 10-point plan of green industrial revolution, which had this objective of building better back to support green jobs and in general to facilitate this transition to net zero society. So all in all, I feel green recovery is an important part of this recovery packages. And I think it just reflects the fact that there is a greater recognition and understanding the climate emergency and the fact that addressing those challenges associated with the climate change will be required, especially in the medium term and the longer term, to begin this or to continue this more sustainable path of development. So that will be my introductory comments.
That's very extremely interesting. I think a very interesting part of the debate as well in terms of the recovery. So thank you very much, Carly, Gash. I think I'll follow up with questions to each of you, and I'll probably do them in reverse order. So Carly, Gash, I'll start with you if that's okay. My question really is if you could say something about this relates to actually a question that's come in the Q&A box. So Tim Malone kind of notes that we could find ourselves in an era of pandemics, in part created by climate change, which I think is an interesting, frightening thought, obviously. I'm interested in what structural reforms do you think we need to make to our societies to make ourselves more resilient to these types of large shocks going forwards? Do you have any kind of practical suggestions or any thoughts on this?
Yeah, thank you for this question. Yeah, it's very important. So in terms of the structural changes, I feel, okay, so first of all, I would say that COVID-19 pandemic illustrated, presented acute public health threat, right? And of course, it required immediate attention. But for me, climate change presents a larger threat to public health globally, especially in the medium term and the longer term. Even more, I would like to emphasize that I think the awareness, public awareness, and also recognition among policymakers that there is such urgency in addressing climate change is evident. But for me, even bigger concern, and I think the threat to our societies is actually ecosystem loss and biodiversity degradation. So why I would like to emphasize that? Because I feel like environmental degradation is directly linked to COVID-19. Because if you look at the most recent infectious diseases which led to pandemics such as SARS, then HIV, Ebola, they all have originated because of the viruses jumping from wildlife to humans. And there is increasing evidence which suggests that that was the case with COVID-19. So I think the destruction of natural habitat by humans will basically increase the risk of pandemics in the future. And I guess there is already general consensus which emerged among scientists that we will have more pandemics in the future. And I guess the question is whether we are going to respond to each pandemic in the way how we responded this time by shutting down the global economies for 6 months or even longer. So for me, the visible way forward, viable way to move forward is exactly to address this big structural, to implement structural changes in the economy in order to follow carbon neutral and sustainable path of development. And just to name few in terms of the structural changes, I would say that, of course, we need tailored public spending into innovation, green innovation. We need to address the issues of deforestation, especially in the tropical countries. I think we need regenerative agriculture because the way how currently agricultural sector I think produces goods and services, they are not only unsustainable, but also they are detrimental for the planet. Yeah, and also I guess we need to change our habits to some extent. But just to conclude on positive note, I feel like COVID-19 has been also a natural experiment which illustrated that we can mobilize substantial financial resources. We can find and we can coordinate on these global challenges.
Thank you, Carly Gash. I think I'll ask a similar type of question to Jonathan, if I may, and I'll frame it as, you know, what structural changes, Jonathan, do you expect to endure in the post-pandemic world? You know, are there kind of changes in the way we're working, or changes in labour markets or welfare systems that you think we won't now go back from that are kind of positive?
Well, there's what I think will happen, and what I think will happen, and what I'd like to happen. Clearly, the pandemic has accelerated some changes that were in progress anyway. It's sort of given this huge push towards remote working and working from home. So I think, you know, the consensus, which I share, but of course we could all be wrong, is that you will see for those of us who can, that more and more people will behave like academics already were behaving to some extent. That is to say, keeping irregular hours, not going into the office every day, and all the rest of it. But that most of us will still want and continue to have offices, and that therefore the sort of fundamental structural changes in the location of economic activity, the hollowing out of cities and so on, will probably be less pronounced than some people predicted very early on. So that's one issue. I mean, I think the other issue which I think which I alluded to in my opening remarks, where I think things have really heightened the contradictions, but I don't know what will actually happen, is around the area of the gig economy and insecure and precarious work, where both the growth of that part of the economy, its importance, its economic and social importance, and yet the downsides of it to some extent for many of the people who work in it, in terms of economic and other and social vulnerabilities, have really been highlighted by the pandemic. And in that context, for many of you, especially those based in the UK, will have seen the Uber judgment about the employment status of people working for Uber, which I hope will become a sort of a moment in the debate, at least in the UK and maybe more broadly, about forcing society to rethink, the old model of 20 or 30 years ago that had extended since the war, of how we share the employment risks between the individual worker, the employer, and the state. That model on which the welfare state and our system of employment regulation was founded has broken down, not because of anyone's fault, but because of technological and social pressures. We need a new model of how we share risks between the employer, the state, and the individual that accommodate that technological change. And I hope that one of the changes that will be lasting is that we really put some effort into working out what that sort of model would look like in a way that worked for all of us, because I don't think we have it yet.
It's a big issue for us to think about. Very interesting. Francesca, question for you, if I may. Perhaps you could kind of say something about the same type of question. So implications of the pandemic in terms of structural changes in the way we do things, but this time for macroeconomic policy. So what do you think what are the implications that central banks will kind of take from this, or governments setting fiscal policy?
Yes, thank you. So this is actually a really interesting question, and Jonathan was mentioning he wouldn't get into the issue of inflation, but I think given what we're talking about, I'm going to address some of those issues without venturing in a forecast, but more talking about what I think the potential issues are around this. Let me start by kind of saying that when the COVID pandemic struck, the policymakers were facing already a lot of constraints in their ability to react to this shock. Interest rates were very low, implying limits to the tools that monetary policymakers had to stabilize the economy. In many economies, debt levels were really high, and this could curtail the efficacy of the fiscal interventions by inducing expectations of costly fiscal adjustments. Nonetheless, the response in terms of monetary and fiscal policies to the COVID pandemic has been unprecedented. We have seen exceptionally large, open-ended fiscal support programs, and these were coupled with exceptionally large purchases of government bonds. So the COVID shock, which combined features of a demand and a supply shock, was huge, and declining confidence, lost corporate income, in the service sector, bankruptcies among SMEs, credit constraints resulting from the accumulation of non-performing loans on balance sheet, and the rebuilding of savings could cause hysteresis sort of effects, and therefore prevent a return to the pre-crisis path. These sort of risks, this kind of hysteresis effect, justify, I think, the magnitude of these measures, and indeed this is also what the kind of Jonathan was mentioning as the, in some sense, a consensus in a big part of the profession. But obviously these measures have also raised fear about a resurgence of inflation. So those who worry about inflation point to the fact that the supply restrictions due to COVID have reduced the gap between output and its potential, and that therefore these enormous stimuli, especially the one in the US, which has been really massive, could cause overheating. Those who instead, defend these measures and are not too worried about the overheating, point to the fact that the Phillips curve has flattened, and that therefore, even if the economy is overheating, they don't expect big increases in inflation, which in any case has been very subdued for over a decade and more. However, there are risks around, what can happen to inflation. If inflation were to take off, there could be, two scenarios. One in which the policymakers would let inflation increase, perhaps substantially, and therefore, they could risk causing a de-anchoring of expectations and, canceling one of the major accomplishments of monetary policies in the last 20 years, which has been to effectively anchor inflation expectations, but also making monetary policy more difficult in the future. On the other hand, and that is probably more likely, policymakers could tighten monetary policy, again, substantially if inflation rises. But this would, these increases in the interest rate might have to be large, and this could lead to, big problem in financial markets and debt sustainability and so on. And so there's these trade-offs that we are going to have to face. And I think the jury is still out there in terms of how this is going to play out. But I think, the key things of how, central banks interact also with fiscal policy, how central bank independence is maintained, how credible central banks will continue to be, is going to be an important aspect of this.
Thank you very much indeed, Francesca. Okay, let's move to a Q&A session now with audience members. So perhaps I could ask all the panelists to put their videos on, because I'm going to be asking you questions directly from the audience. I'm going to start with what I think is a really nice question from Chris Williams, who asks, what evidence and arguments can the panelists give us to kind of reassure us that the world economic shock caused by COVID will not trigger a prolonged economic slump, similar to what we saw in the 1930s? Jonathan, I'm going to start by posing that question to you because you gave us this nice distinction between, you were quite optimistic on the macro side, but concerned on the micro side. Here's a kind of a direct concern on the macro side. What gives you comfort that we're not going to end up in the 1930s?
I mean, I guess the first, my sort of prior is to say, well, why would it, right? We've had a very nasty virus, which has killed a lot of people. That is tragic. But its impact on the capital stock, either the human capital stock or the physical capital stock, is, to three significant figures, essentially zero, as far as we know. And vaccination will, assuming that vaccines work, and then updates are reasonably available, so that the worst that happens is we have to get vaccinated once every year or something. What has changed? What have we permanently destroyed? Some businesses, we will have lost some good businesses, presumably, but probably not, because governments acted mostly relatively sensibly, relatively quickly. It's not obvious that we've lost that many. And the sectors which have been most seriously affected are sectors where, accommodation, restaurants, customers are sectors where turnover is very high anyway, and there's not really a huge amount of embedded capital. The one thing where I think there is probably some permanent damage is to the education of children, and that is a loss, but it's a sort of one-off levels loss that is hope we would like to make up, and with good policies we could make up, but maybe some of it won't be. So I'm just not sure where I see the permanent damage from this pandemic coming from. If we did have a huge banking crisis because some banks fell over and brought down other banks, that would be a different matter. We know that those do permanent damage. But that doesn't, there's no evidence or reason to worry about that yet. And I guess my view is that on the whole, one thing which really struck me about this pandemic, which I probably knew in a sort of objective academic sense, but wouldn't still have got wrong, was how adaptable humans are socially. So if you told me 2 weeks before lockdown, in other words, exactly a year and 2 weeks ago, how will we take only being allowed to go out to shop once a week and not being able to go all the rest of it? I'd have said, my God, that'll be catastrophic. Actually, for the most part, society adapted rather well. And indeed, we've seen that the economic effects of this current lockdown have been nowhere near as severe as the first one. And I guess my view is that, we will also, and history tends to support this, snap back rather quickly as restrictions are lifted. So, we will change some things about psychology. There will be some permanent damage, and maybe it's accelerated some trends that were happening already. But I don't really see where a sort of big long-term structural macro downturn is coming from.
Thank you. It's a very thorough answer. Actually, for those of you who are interested in the issues Jonathan's just raised, the IMF have actually just put out a report today on their website on this question about the scarring effect of the recession, which actually makes very, very similar points to what you just said, Jonathan. So I'd kind of encourage anyone who's interested in those types of issues to take a look at what they've written. Okay, we've got some kind of very nice questions in the Q&A that I'm not entirely sure who to ask these to, so I'll raise them, and then if any of you fancy coming in, please do so. So here's a question from Raghav Mathieu. Raghav, nice of you to join. I know you join many of our events. Raghav asks, we're seeing concerns surrounding the rise of zombie companies, which have been artificially propped up and allowed not to fail by government support packages. In terms of long-term growth, should this be a concern? Is there anything policy should be doing to address this issue today? I don't know, Francesca or Carly, Gash, if either of you want to come in on that.
I'm happy to come in on this. I think this is an interesting and important point. First, I'll kind of echo what Jonathan was saying, and kind of, confirming that I do think that the extent of the measures that have been put in place have really helped in kind of avoiding these scarring effects that we were talking about. And in some sense, this is true also for, when we think about firms. So definitely, the substantial support that has been put onto firm has, helped to support firms that, are viable, but might not be at the moment solvent, etc. But that once the pandemic will be over, we'll be able to continue being profitable and so on. But there is an issue around firms that are both not viable and not solvent. And so I do think that as we come out of the pandemic, the sort of support that has to be given to the economy has to change in some sense, maybe with more guarantees, but also thinking about restructuring and dealing with these legacy debts in a more, elaborate way. So I do think this is an important issue. which I think, I mean, definitely there is a thinking going on in this scope, in this perspective, trying to understand how to simplify the debt restructuring of firms that are, identifying the viable ones from that should be supported more from the ones that are instead non-viable. Thank you.
Thank you very much. All right, there's a great question next. I'm glad someone asked this. So this is from Shabana Yusuf, who asks the great question of how effectively and productively do people work from home compared to in an office? Would any of you like to step in on that? Carly, Gash, you're welcome to kind of answer that question or also touch on the preceding two beforehand, either from your own experiences or any research you're aware of.
Yeah, okay, I guess, all right, I don't know much about the empirical evidence which suggests. I guess my impression was that evidence is inconclusive in a way. Of course, it depends on which industry. Some people, again, it's also probably, there are some, as Jonathan mentioned earlier, it depends on families with small kids versus, I guess, single people, etc. I guess it depends. So my impression was that some people benefited working from home. They have become much more productive. On the other hand, people with small kids, especially, I guess, female workers, experienced additional, I guess, challenges handling this family and kids. So that's why I think the effect, let's say again, this is one of the implications that Jonathan mentioned or referred earlier in terms of the distributional effects of the COVID, of the pandemic. I think it has been uneven across populations, but also across countries as well. So it's, I guess, going back to the earlier question on whether we become optimistic about the future, I guess, rebound in economic activity from COVID-19, I guess situation is much more challenging in developing countries, especially countries which are highly dependent on tourism. And so I guess the increase, I don't remember the estimates, but overall, they expect quite large number increase in people who will fall below the poverty line across developing world. So I guess my position is less optimistic than my fellow panelists, I guess. But yeah, overall, just to conclude on this question, I think the evidence is mixed. It again depends on the individual situation.
Thank you, Carly Gash. Actually, there is that touches on a kind of a question in the Q&A. Luis Felipe Kling asks whether the panelists have any views on what you expect to happen in emerging markets like Brazil and Argentina that were already facing crises before the pandemic hit. Do any of you have views you want to relay on that question? If not, I will ask you another one. So I guess another kind of
I can share my views on this very briefly, I guess.
Yeah, please do.
Probably it wouldn't be much comprehensive answer to this question, but so of course we have seen that Turkey experienced a significant banking crisis, I think following this COVID-19, and I believe it is sort of related. We know that the Turkey is heavily dependent on the tourist sector, and also a country which experienced, I guess, financial crisis before throughout the history. I guess it's also related to the fact that, I don't know, the fact that the global economy heavily depends on reserve currency, which is dollar. And it also, therefore, during the crisis which happened following the COVID-19, it's not just only separate emerging countries like Brazil, Argentina, or Turkey experienced this type of the challenges, but it's like the whole world experienced this one. And given the unique position of the dollar, I guess we know that there was a system arranged by different central banks when there was some currency swaps, right? For instance, Federal Reserve print dollars and swap with European Union for euros printed by European Central Bank. So I guess given that, of course, there is limited number of dollars that Federal Reserve can print, it also sort of reduced access some of emerging economies to this type of the pot of money, which maybe they would have been able to access in sort of normal financial crisis situation. So the fact that this crisis affected all emerging countries at the same time, I think that was a challenge.
Thank you very much, Carly Gash. I think I agree with your sentiment there. This might be the final question I relay. Let's see. It's another very good one from Alex Cassidiaris. Alex, I'm hoping I'm pronouncing your surname okay there. So Alex asks effectively about the sustainability of public debt and whether this should be an issue, not just in the UK, but around the world. Is that a question any of you want to kind of offer your briefish remarks on?
I mean, the burden of debt in the UK is, I think, at its lowest ever level, right? In recorded economic history. In other words, interest payments as a proportion of GDP or as a proportion of tax revenue or as a proportion of the budget are lower than they have ever been since we invented the August institution where you two used to work in 1694. I mean, probably before that, if you regard the king's debts as the national debt. At the moment, we are very, very far away from the debt being any sort of problem in sustainability terms. So the question is really, under what circumstances would interest rates rise sharply, and what would be the policy response? For me, it's very hard to see why interest rates wouldn't rise sharply, except under conditions where demand was rising. Demand and private sectors consumption and private sector investment were also rising sharply, and those will by themselves mean that most of the sort of flow problem, the deficit problem, actually goes away, because a booming economy will deal with most of the problem. Will there still be a structural deficit in the UK and many other countries, driven by a combination of the gap between what people want to pay in taxes and what they would like the government to pay in public services under the conditions of an aging population? Yes, almost certainly there will be. That is something that's been the case sort of for quite a while and will continue to be. It does not strike me as, it's a political problem, because, you need to persuade the public either to accept higher taxes or that they're not going to get the public services or pensions that they think they deserve. But it's not, in my view, a sort of, a sort of short-term panic stations problem, as opposed to a sort of a fundamental issue of political economy, which we will doubtless continue to discuss and argue about for the foreseeable future.
Very good. Thank you, Jonathan. And Alex does suggest that this is a topic for a future webinar, and I think he could be right on that. So there's many aspects to that debate we could touch on. We're pretty much out of time, and I want to leave one final question for each of the panelists, and that's, I think it's nice to kind of end these types of talks on a kind of a positive note. So perhaps if each of you could kind of just give us one reason to be optimistic about the economic outlook from here in a couple of words. Maybe let's start with Francesca, if that's okay.
Certainly. So let me give a more backward-looking reason and hopefully a more forward-looking one. So in terms of backward-looking, I think, the policy action was swift throughout the globe with extensive both public health measures, but also fiscal measures and monetary policy measures. And I think this has, will make the recovery easier, much easier than it would have otherwise been. So that's already a positive. On a, this is a much more, the second thing on a much more, wishful basis is that the situation has shown the importance of, research, and the government has supported, vaccines research and is, has seen that this kind of sort of support has paid off. So hopefully this will boost further, government spending on research, which might also help with the quite dire UK productivity situation. So that's a more wishful thinking sort of forward-looking.
Okay. Carly, Gash, I'll ask you next. If you can keep it to 30 seconds because we're about to run out of time.
Yeah, okay. So I think it is related to what I discussed earlier. So I would say that climate emergence was gaining momentum before COVID, but once COVID hit the global economy, I guess there were these concerns about whether this is going shift the whole focus on economic recovery rather than to issue policies to deal with the climate change. And I guess as there was a debate whether there is a trade-off between public health and economic growth, similar, I guess, debate resurfaced like there is a trade-off between economic growth and climate change in the environment. So it was positive to see that there is recognition that actually there is no such trade-off. And as we have already discussed today, important packages have been incorporated in stimulus. So I guess solving climate change will be on the agenda. So that's
wonderful. Thank you. And Jonathan, your message?
Well, I won't repeat what I said before, but I think the scale and ambition of the Biden stimulus package, which some estimates suggest will halve child poverty in the US within 1 year, I think illustrates both what is possible and if, fingers crossed, it is actually successful, that is, it generates economic growth with equity and without inflation, it will be very hard for the rest of the world not to look at it and think, actually, that's the right thing to do, and that would be good news.
Yeah, wonderful. Well, let me just thank all of our panelists for, I think, what has been a really stimulating discussion. I've certainly learned a lot from, and I hope you all have as well. I'd also like to thank the Alumni Office for putting this together, but let me hand back to Francine, if you want to close the webinar.
Thank you very much, David, and thank you to all our panelists and to our audience for such an interesting conversation. It's been wonderful to have you all this evening. If you'd like to learn more about this topic, do let us know in our post-event survey so we can share further resources with you, such as the link to the IMF report David mentioned. And just a couple of updates, from the Alumni Office. We'll have our next Alumni at Home event at the end of April during International Dance Day, where you can join a fun and energetic morning dance session to start off your day. We'll send you a link after this webinar so you have more information about it. And do also keep an eye on your inbox and our social media channels for our next King's Expert Series webinar. Thank you again for joining us this evening. We look forward to seeing you soon.
Thank you, everyone. Bye-bye.